Yeah, that's what I thought in the morning. Alright, excellent. We separated it properly now. Before I forget. There we go. I just had to fix up those first two reversal points. Sometimes I accidentally touched them. It happens. And make sure this one's perfect down here. I'll probably fix this line down here. I don't know why they used to connect. Somehow I guess I touched it. There we go. Looking much better already. So again, until the market gets below this box here, you're still bullish the whole entire day, just like yesterday. That's how you could tell. You have a red box, you have a green box. You hit King's Point finally at 636. So the next King's Point is going to be down here at 618. Yeah. That's a pretty good distance away. Okay. So we already ran through all the ideas for now. Simple ideas, of course. But the market's still stuck consolidating in this small little range. So the next option we're going to buy is going to be a 630. If not, maybe a 633 put. We're just going to have to wait pretty much all day. Because we don't want to keep throwing capital into a market that's just still stuck at the same location. When our intention is to play a market, it's moving week to week to week. So we're aiming for new highs, new lows. We're not aiming to play in the middle with a very cheap amount of money, because that's not how you grow those small accounts. In order for you to really grow a small account, you do it two ways. Either consistent trades, which usually takes a couple years to learn how to, be consistent, or you're simply waiting for the market to do something extreme, and the day it does that extreme thing, you know how to play against it. So you only really need to wait for the price actions to start ramping up a little bit, and then that extreme thing will then happen, right? And then you're going to be waiting. Once something crazy happens, boom, now you trade the market. Any other reason, you're not really trading. So like, for instance, when Trump made the market fall out the sky in February and in March and April, you would have traded that at the lows with calls that expire in a couple months out. So now, since we're at the highs, of course, I expect you all to do the same. The one sad reality was that about 95% of the people who bought at the low, they didn't really put too much capital into the trade. So even though SPY ran up from, that crazy low of 480 all the way up to 550 first, like 540, when it did that, about 95% of the people who played it sold it really early, and two, they didn't have enough capital inside the trades. If you had 1,000 to 5K, that's perfect. But everybody only bought 1 to 2 options, and that was it. Nothing else. So it's kind of unfortunate. It's kind of bittersweet to say the least. So it's kind of funny as well, because I'm almost 1,000% sure 95% of people are going to miss the downside as well. And then when the market moves to the downside and falls, obviously people are going to make their money, but very few people, because there's only a few people that really hold for monthly and weekly moves. Everybody else sells really early, and they don't really grow at all. So yeah, just take it real slow. Buy an option a couple weeks out. As long as you already bought one at 605, 615, 620, and those small little ranges in between, then you're perfect. You don't really got to spend too much money on the puts right now. You're still welly positioned. Now, if we run up into 640, 660, you're going to have to buy a new set of puts for the yearly and the monthly, meaning for December and for May of next year. Once you actually run up to 640, 660. Let me see. Everything else is pretty much already sorted out. We're just waiting now for the prices to get really cheap for these contracts. Now they're dropping, as you all can see. What time is it? 10:30. So after about an hour, it seems like the contract's finally fallen off a cliff. How about the calls? Calls for 638. That's perfect. That's really good. If we could see the 637s drop to $6, $10, that would be even better. I'm assuming the market's going to make their move by around 11 to 12 o'clock. So we just got to wait till 11 and 12. Let me see something as well. That's actually crazy. Wait a second. January 28th and 29th was last FOMC. You crashed 2 days before it when you were running up into a new high. I just remembered that right now because we got into like a $5 play up here and it was 200 each down here. So that was a drop of like $13, $14. That's what I think is going to occur now. How many days do we have away? 5 days. It's right on par, I guess. So you had a high here. What was the number it hit? 610. And then over here, 607. So imagine this is like 626, right? 636. That means we might run up to 640. Another $4 against what we ran. Because today there's 5 days left. Over here there was... It occurred how many days before? Literally the day before you got shut down. So it's Friday to Monday. And then the FOMC was Tuesday to Wednesday. So Friday to Monday you crash, then Tuesday to Wednesday you start running up. FOMC comes out. Let me see here. 610. And then when you drop down to the midpoint of that whole entire range where you dropped from the previous FOMC in December. That was December's. This is January's. And then where's February again? February didn't have one. It was March 18th and 19th. which explains why February was so good. So as you all can see, you're now doing an extreme move on SPY here. I was fixing up the other chart off screen. I don't know why in the world I was fixing it on screen. That was ridiculously not smart. But it's whatever. I'm not gonna get mad at myself. Again, I'm looking at the put side here. Oh, these are 3-day contracts. I'm like, why did the price go up and you went up higher for the puts? And then, like I told you all in the morning, if you're trying to play puts, you have to hit the pink line and fall from it. If you're trying to play calls, you got to get above the pink lines and play to number 4. We might get an opportunity to even buy the 633 puts. As long as you keep consolidating here, you go up a little bit higher. All right, so I'm writing some of these notes here to fix up. So after you fall down on the 8 and 13 EMAs for the first time, you want to hold the EMAs and run into the sky. Oh, I should put that here. And then over here, I could delete this. Okay, so let me think. That's 1. That's 2. After you fall down on the 8 and 13 EMAs the second time. After the first cross, you run into the sky. After the cross, first time, that's where you'll buy to continue to play the upside. You're falling the second time. The amount of time you'll hold these contracts depends on that day's momentum. Alright, excellent. There's nothing else for me to fix this. Because after you do that, then that's it. And then when you're falling down... Actually, there's one more entry. trying to include everything that a person would need so that there's nothing that one can't understand. Let me find another note. I think I'm missing something here. Yeah, I'm not gonna have this one on the screen, so I'm gonna go like this. Control copy. Go like this. Make it pink. There we go. Now I can delete all of this here. That will be on the Discord, stuff like that. The normal everyday person does not need to know how to calculate the EMAs or the 200 moving average. That is just unnecessary information. So the only thing a normal person or the everyday trader would need, if you're a coder, I mean, of course, that makes you a little abnormal. So you, of course, probably will need the calculation of it because you're probably going to code it for something. But obviously, if you don't need all that information, you could just have it on your screen in a certain corner or just write it down so you at least have read it before and have seen the calculation. Like for the EMAs, I can explain it really quickly for you. EMAs are short-term moving averages. They rely more heavily on the short-term price range. So like whatever the last week's range was, specifically today and yesterday, it relies more so on that information. With the 200 moving average, it just relies on the last 200 days. Just like that. I think these are just like some big ass notes to keep on my screen though. This is still like a really big note. You want to realize things, staircase, who cares about all that? When trying to scalp, it's with this staircasing idea in mind. That's all you need to know. When trying to scalp, okay, for instance, you run to the 200, then crash $2 before hitting it. Then later on, you run back to the 200, now hitting it. Then crash again. Boom, that makes sense. Everybody can understand that very easily. After a certain amount of time, no. Then you run back above and now hit the 200, go above it, and now you're holding on it, potentially about to swing higher to continue a trend. Let me see, does that make sense? Or do I gotta have more information? Then you run back above it, and now you hit the 200. Then you run back above, now you hit the 200. Go above it, and now you're holding on it, potentially about to swing higher or continue a trend. Yeah, that's fine. So again, most of these ideas prioritize calls. However, if you just flip it vice versa, you'll basically understand how you should play with it for the put side. It's just opposite of what I'm saying. If I put the put side as well, it's going to be way too much stuff on the screen. Because remember, every side is similar in a certain way, and every side is different. Calls and puts are a little different from each other. So for me to be able to give you a perfect explanation, kind of like how this one is, it relies on not just random everyday price action, but it relies on you doing a certain pattern. And then once you see the 200 doing a certain pattern, then you start using the idea of how to trade it and what to do next. Does that make sense? So it's not like you're randomly using it every random day. You're always waiting for it to do something on one day, and then once you see the whole entire day at 4 p.m. it did not hit the 200 moving average the next day, that's where you follow this. So it's pretty easy, honestly, because again, you're waiting for one day to occur, and then you're always waiting for that day to make that pattern where it doesn't touch the 200. And then the next day, you want to see if it's going to continue that pattern or basically touch the 200. Because now, instead of you just playing the ghost touch, which is the pattern from yesterday, you could literally see how you can now staircase downwards to touch the 200 that next day. Or if you're just going to do another ghost touch, you have all the entries in mind already. Which, if you actually look at it, it's kind of crazy, because think about it for a second. With the 200 moving average, with that first point that I wrote, that's 1, 2, 3, 4 points. That's like 4 or 5 points that you could buy into. Because it's 1 point that you're missing. Actually, no, that's not a point. For instance, you run to the 200 and crash $2 before hitting it. That's not a point. So this right here, that you would basically have to wait for that to occur. But then again, I could make this even better. I just thought of it right now. I'm trying to computerize the explanation so that it's so easy, so simple, so advanced that it makes up for both directions at the same time. It's kind of like the perfect way to always trade, because that actually exists. For the most part, calls and puts are traded differently. They react differently to momentum. They react differently to price action. If you're running $300 in the sky versus if you're falling $300 in the floor, the way the market reacts is going to be way different. Even if you have bearish days when you're running up $300, because of course you're going to have some days where you fall like $20, $30, it's still not going to be the same market or the same way you trade a bearish market that's falling out the sky. Both of them are two separate things. How do you separate it? Well, point blank, what's bullish, what's bearish? If you know how to actually calculate that and how to understand what's bullish, what's bearish, which usually it's just midpoints and quarter points. That's really it. So if it's above a midpoint, if it's running towards a quarter point, if it's now at a high, you know what I mean? These are all the things you want to pay attention to, because then if you're at a low, or if you're not touching the 200 moving average on the 15-minute no more, or the 1 hour no more, or the 4 hour no more, you might do something massive to the downside. Like, remember how I was teaching you guys about this yesterday? This chart right here. This one right here. And we told you all that the simple fact that you were above these lines on the green, and then now you fell to the midpoint of the green, then you fell to the bottom of the green, ran to the quarter point, fell back to the bottom, then through it, which is terrible. Now you're bouncing on it a little bit, fall massively from it a couple days ago, right? You fall about $5 straight down. Then you run up to the line again, and you almost touch it yesterday. As you can see, you almost touched it yesterday. So this is where you're currently at right now. So yeah, the market might just want to, run up into here, 638. Which if it does, that's perfect, because that matches up with... Let me keep scrolling, give me a second. As you can see, matches up with number 4. So again, how do we continue to play this? Like I told everybody in the morning, when we hit the pink line, that's your entry for puts. When you're trying to buy calls, you're going to buy them above this pink line right here. Now, how do you go about buying it? Do you buy it instantly when it crosses? That's one way. I sometimes see people getting into entries like that. What's my favorite way to buy an entry is to let it cross above, run above to number 3, maybe fall down to number 2 after some time, and then you buy into the call for it to run up to number 4. That's the way I trade this. So sometimes it just runs straight up to number 4 and I don't get into the calls. I miss it. But it's much safer than me getting into a call here and then the market reflecting off of this and then falling down the whole entire day. You know? So you're making a little bit less in terms of a gain. However, it's more of a high probable setup if you can actually wait for that to occur. Now, let's say if you buy here and it falls right through it, where you're instantly market filling to sell out, because that's not what you want to see. But in our case and in our scenario, I guess you can see that today because number 2 is a little bit below the pink line. So yeah, I'm just going to buy on number 2, and if it falls below number 2, I'm out. So again, let it run us to number 3, fall down to 2, buy into the call. It might take another hour, maybe. And then once you buy into it, if it runs up to number 3 and slows down again, just put a stop loss. So if you buy right down here and it runs up to number 3 again, just put a stop loss, just in case this thing just consolidates the whole day like it's been doing the whole entire week. Alrighty. When we hit number 2, because you're about to hit it right now as we speak, let's go ahead and look at the puts. So the puts we bought into are still the same price right now. They're at $6. However, the 632 puts are now at $8. So what we might do here is just sell out of the puts that we got earlier and just buy into a whole new set of puts here. Buy like a 632 when it falls down to 5. 632. Yeah, you're still extremely close to it. Opening price was at 635. So 632 is $3 below that. Right now you're at 6. Yeah, you barely did any single move today. You still have not done a single thing. And these options are getting absolutely destroyed. This is insanity. This is crazy. By destroyed, I mean for some reason they're all going to $5 and $6. Like they're kind of slowing down to that level and then stopping there. There's no reason why my option is still not down right now. Let me see. Are more people... Are they increasing IV? What are they doing? What is IV right now? That is terrible. No wonder. IV is at 10% right now. If they just start buying up this market, like right now, you're just going to start slingshotting into different directions. So, like I told you all before, allow yourself to hit reversal point number 2, and then the first thing you're going to do is, remember, this is reversal point number 2 right here. So it's at 636.49. If it just falls from here, I mean, who cares? Just let it fall. Don't put much emotion to it. The market always does this. So the next thing you would do is 2 things. Let's say if you wanted to get an entry really, really, really bad and you planned for it like the prior days, and the market's just about to do it, and let's say your entry was at that number, there's 2 ways to go about this right now. The 2 ways is, whenever you're buying off of a certain specific point, you need to realize that the market has a range around it. So let's just say if I wanted to hit 636.49, that means if it goes, you could say, let's just use this little tool right here. So again, 636.49. So what I'm going to do is I'm going to go up 20 cents, 636.69. I'm going to make a box here. And then I'm going to go down here. And it's going to be 636.29. Keep going down. Right here. So every single point that you see on my screen has a range of basically something like this. So there's 3 different ways to get into a single point. Like a single entry on my screen. There's always 3 ways. Which I guess I could put this box here now. Maybe I'll find a way to make this nice, so that everybody can always know what entry they got. Because I could get real nitty gritty with the ideas. Because again, There's a lot of information a person needs to be able to trade effectively. This is just one of the things that I took a couple years to learn. So again, that's literally how close it is. So if you buy off a put right here, you could have just waited for this put here, or this put here, or this put here. Now you can see all the different layers of puts and which one you can get. Same thing with the fourth one up top. Now, for me, I'll be real with everybody here. 20 cents, I don't like it. That's the first thing I'm going to tell you. But this is what I taught people in the beginning, and this is what I still tell people now. It's usually around 20 cents. Sometimes if you have like a crazy day where momentum's like in the sky. But then again, like I would have to explain that. So I guess we could explain it right now, actually. Okay, there you go. We already explained this. I can actually add this thing up here to the main list of points. I'm gonna put it right here for now. I'll fix it up in a second. I want to just continue to fix this real quick. Okay, so let me explain what I like. So I don't use 20 cents. I don't like that at all. I use 10 cents. If a point is 10 cents away from my entry, it's basically a time for you to get in, basically. So if I go 10 cents below, that's 639, 636.39. That's exactly where the market hit, basically. That's what I personally use myself. The reason why I use 10 cents is because sometimes SPY is a little unforgiving, let's just say. It's not really nice to me sometimes. So I've developed a way so that it pretty much always goes my way. So even if I'm a little far away and it's not at the perfect point, you're still technically at the point, at the area. So I wouldn't miss my trade. Because if I'm for sure that this market's going to do something on this area, you should have no problem running up to that bottom point. But here's the thing. This is only for markets that are a little bit slower. If a market is fast, meaning a lot of momentum, you always want to buy past the point. Meaning if I'm going to buy puts, I'm not going to buy the puts right below number 2. I'm not going to buy the puts right on number 2. I'm going to buy it right between number 2 and a little bit below number 3. If I'm trying to buy for the second reversal point. So you have to get real specific with it. Just because it's a reversal point and you should buy puts at that level, you got to do it with a certain idea in mind. Now, again, because this market has been consolidating all week, I would tell you for today, you could buy at the bottom. So now you could buy at the bottom of 636.39. Whenever you hit that level, that's your entry. Now, if the market speeds up, of course, you already understand what that means. If you're going to buy on number 3, that means you're actually going to buy puts a little bit above number 3. 10 cents above it. You could go 20 cents above it if the day is just like really fast, really crazy. Because you might actually get that. And you waiting those extra seconds for that extra little wick is going to cause those contracts to be an extra $3, $4. And when you're buying 20 of them, 30 of them, it really does matter. You got to get that perfect buy. You don't have to per se, but you want to get as close as possible. And the only way you'll get close to the perfect buy is at these reversal points. I can guarantee it. We see it every single day, you know. Even with the first reversal point this morning, right? You ran up to that perfectly and then fell from it. That's literally an easy 50-30% trade right there in the morning. And it does it every single day. When you fell down and you almost hit number 1, it didn't really hit number 1, but it's kind of funny. It's hitting my other trading style. So the trading style that I use to create these reversal points, it's more smaller than this one. This set of reversal points was made for a market that was faster than the market that occurred a couple years ago. So the market that I was trading in 2021 and in 2022 and in 2023, it's not the same reversal points as these. The other ones are way smaller. So in my other reversal chart, you're actually perfect. Like this price range in the middle, like the price action right here at the beginning of the day, is actually a consistent thing that has been happening for the past 4 or 5 years, ever since I've watched this market. Sometimes it's very fast, sometimes it's very small. The point that I'm trying to make here is that there's a certain range every single day, every single morning, up and down, that a market might consolidate. There's also a certain range up and down that a market might run into. Like, remember how some mornings you just run from the opening price straight up to number 4? Remember those crazy mornings? That's why I have this reversal chart here, is because when those crazy mornings used to be the everyday normal thing, we used to wait to trade on number 4. Now that these markets are basically in the midst of changing directions, meaning you're going to fall out the sky soon, whether it's $15, $20, $30, you're still going to fall out the sky soon. Now, if it's a $100 drop, $200 drop, I think at this point, that's only going to occur after we hit 640 or 660. So once we hit 640, 660, then I think we're actually going to drop in terms of the yearly for like the next couple months. In terms of the weekly, I think you could drop just because you have FOMC coming up in 4 days. And last time, 4 days before FOMC, the market crashed out the sky. It was basically falling for the whole entire day. Today, you're running up so far for the whole entire day, so that might be a hint as to what's going to happen on FOMC, because that's the complete opposite to January. Again, January, you crashed 4 days before. You were at a high. You were running up. You were above a previous high. And then you crashed. That's how we actually turned our $5 into around $200. So this trade right now has the potential to actually make us go up 5,000% overnight here. Like, it's literally today. So what I want everybody to do here is basically just, of course, be very careful. That's the first thing, right? 4 days before this is basically 1. So look, 1, 2. Am I counting wrong? 1, 2, 3. So no, yeah, you're even closer than last time. You're 3 days away now. So because the 4th day, which was actually yesterday, because remember, FOMC is on the 30th. Is it the 31st? No, the 30th. So FOMC is on the 30th. I already forgot what chart I was looking at. Oh no. We'll just look at this one. Actually, we'll just look at this one here. So FOMC is on the 30th, which means I'm thinking that you'll get something a little insane here. If the market just keeps running up right now, that's perfect. At the end of today, or when we hit number 3, I'm probably going to get another put overnight. I might even buy it right now, just because of what happened a couple of FOMCs ago. Just to have something on the board. And again, you just get 3 days out. Just get it for Monday. And the second we open up, you just instantly market fill at open. If you want a couple of them, just instantly market fill 90% of them, 95% of them, and hold one is what you could do. Now, I think there's going to be a $10 drop, basically. So if there's a $10 drop and we're buying a 3-day put, we're at 636, so we would fall to at least 626. These options are around $14 right now for 626. I know you could fall as low as 619 again very easily, but 626 would be much safer for a Monday option. And by the way, if we actually open up, what would happen is you would be about 2 strikes in the money. So you would pay around $13 right now for these puts. And on Monday, you would be selling out for $200 to $300, somewhere in between. Could be a little bit less than that, of course, but anything above $130 is technically 1,000%. That's how easy it is to go up 1,000 to 2,000%. Is you literally just go from out the money to in the money. That's it, pretty much. It's just, how do you do that consistently? That's the hard part, of course. Until you start finding the patterns, of course. Right now, you're about to hit number 3, everybody. So you're very close to it now. So again, if you're waiting for this entry, there you go. If you're waiting to get into the calls, like I told you about the potential upside to number 4. Again, now it's above the pink line, so just wait for it to fall down to the pink line. Get the call that you want to buy, which is going to be a 638. If not a 6, you could get a 639, but just be careful. You might have to sell out earlier than everybody. So yeah, you're just gonna wait. You're not gonna buy it yet. Make sure you switch your limit buy to a market fill, and I'll tell you when to market fill. Just wait for my okay. And then again, your market fill, an option for the call side. What calls are you buying? Just to make sure everybody's on the same page. Again, you're buying a 0-day 638 option that costs $18. The amount that you buy depends on the skill level that you're currently at. So please humble yourself. If you think that you deserve to buy 5 to 10 and you know how to handle that, you know how to basically buy and sell that, then go ahead and do it. If you're not there yet, you're not there yet. Just buy 1 or 2. You got to become your handler, your own handler. You got to be able to tell yourself, all right, this is not a good idea. I should wait a little bit longer so I get a little bit more experience, and then boom. Just think like that. Because in the beginning, trust me, I know how it gets. Especially for me, I remember how I was. Who buys an option that costs $1,600 when they only have $10,000? You know what I mean? A $1,600 option that expires in 2 weeks. That was just some of the stuff I did in the beginning. Or buy 1,000 shares of a random company that I have no idea what they actually do, just reports. You know what I mean? But again, you have to do those mistakes in order for you to actually understand it's a mistake. Even though it could have been completely unavoidable if I just was thinking logically. But again, I was just trying to force it. That's how it always is. So these contracts are losing value right here for the calls, which is beautiful. You just fell from 18 back down to 15. Keep your finger on that button to buy. How's the dollar right now? The dollar is still holding right now. How are the futures? I gotta check euro after this. Actually, while this trends like this, it might just snap downwards. Just give me 1 second. Let me take this out of the screen. Just so I can see. This market. I'm not gonna lie to y'all. This is amazing. Of course, it would have been more helpful for us to actually be moving a lot faster than what we're moving right now, of course. But the simple fact that we're getting a crazy market in the beginning of the year, and then you get a market that's slowing down as much as it is right now, this is the best way to actually teach a person how to trade. So it's phenomenal because it's giving me the perfect ability to actually gracefully, progress with the market. Like when the market's really bullish, I'm teaching people how to trade, really bullish markets. When I know the market's about to switch, I start teaching individuals how to trade markets that are more bearish, because it's all different. You can't teach one person how to trade every market in one day. You can only teach that market for what it is in the moment, because then it's going to make the most sense to them. And then they can start kind of converting themselves into that deeper understanding, which allows them to trade and spot different markets unfolding. Kind of like how, if I go to the target play real quick, let's go look at target. Exactly how I spotted the target play too. I'm just going to hide my whole entire screen and I'll show you where I bought. So just look at target while we wait for SPY. Again, you might fall down on number 2 here, so let's just give this a second. This is taking longer than I wanted to. For target, look what happened over here. You consolidated in 2023 and then blew up into the sky. So because it looked the same over here, I told everybody, all right, we're going to buy here because it looks like this thing is about to blow up. It's down here for a longer time than it was over here. So boom, that checks out. Had everybody buy into this at around 90 to around 99. Some even bought it around 100. And no, I think, no, yeah, everybody was buying pretty much down here. Like right around here. Like 98. Some bought at 94. Contracts went from like 200 to like 160. And then up here, they were at like 300-400. And guess what? You barely even moved anywhere. You're supposed to run all the way up here. But it's my ability to be able to see the patterns in these trends and be like, wait a second. If I make a line at the top and then I make a line at the bottoms, it's kind of like they're following the same thing, right? So that's why I made these lines here. As you can see, it's literally the same thing actually. So target is most likely going to still run up to about this white line here, which is 115, which means everybody holding those contracts will be up about 200 to 300%. And then how do they play the downside? Well, look at my screen. It's already written on it. Wait for it to hit the yellow line. Instantly get into a put. $10, $20. Of course, I don't have the explanation on the screen, but I'm giving it to you right now, vocally. You play an option $10, $20. And every single time, it will fall from the line. It was a hypothetical at first, but because you did it already, I didn't get into the puts here because I told everybody, let's just watch it and see if it works. And look at that. You ran a little bit above it, shot down below the line. That's an easy put play right there. How many days did it took? It basically took it from Thursday to Monday. So 1 week you're up here, the next week you're down here. That's enough time for you to buy into a 7-day play that's, you know, really cheap for $20, $30. So once it hits this yellow line up here at 113, while we're still holding the calls, right, we're going to get into a put play to then scalp the potential reversal, because right here it's just like on the calls we're up, let's just say 100%. Then when you fall down, now you're only up 40%. Well, guess what? Because I also played puts at that point where I knew it was going to retrace that. And I know this sounds like almost like a perfect situation. Like, how do you know it's going to do this and then do this and then hit that? Like, how do you actually know? It's because of patterns. That's all. That's what I want you to understand, is you probably don't understand it yet because you haven't noticed the pattern. Your brain hasn't absorbed it yet. So I'm trying to just make the patterns more prevalent so you can actually see that this stuff is how the market moves. It's all patterns. And that's pretty much all. But yeah, by the time your option goes from up 100% to down 40% because I played puts, technically I might even be up, 200% now. I might have made money on an option that I didn't even sell, but because I knew it was going to fall. So I played against it. And that's it. That's how, this market's depthness is just born. By the way, you're at the line here. So you perfectly just hit the line now. As you all can see, you were above the line on the 5-minute, and then the next 5-minute candle, you're below the line. I still want to see if it's going to hit number 2, though. So we're just going to give this a moment, everybody. Trying to make sure this next entry is going to be a good one for everybody. Alrighty. Tesla is just catapulting up into the sky. I knew it. That was a good buy, everybody. We bought it yesterday at the low. Today, completely forgot about it. Then you opened up, remembered it after like 10 minutes, 20 minutes. And then now you're currently about, I think, how much are you higher from the opening price? You're about $13 in the sky right now. $13, ladies and gentlemen. These options were at $3. They went to $20 each on Tesla. These options are stupid cheap right now on Tesla. How much are the puts right now, actually? Wait a second. 310s are $6? So if you literally just fall back right back down to opening price after you just filled half of the gap, you guys thinking what I'm thinking? Are you guys thinking what I'm thinking? We can get into an easy little 310 Tesla play here. All right, let's do this. Yesterday, you know how much this option cost? Because it's a put. Yesterday's this option was at $1,200. Right now it's at $6. Oh my god. Somebody just lost a crazy amount of money. So far, you're holding on the pink line. So far, so good. We're completely avoiding this terrible price action. All right, let's just continue what we were doing earlier. If you see SPY go below this pink line, which is 636.60, or you see it go above 637 flat, just let me know. It looks like it's going below already. All right, get ready to market fill. You're market filling once you hit the green EMA. If it continues to lag for like another minute, like another 5 minutes, then I'm going to tell you to hop into a different location. Because remember, the green EMA location, I'm only telling you that because this is what the price action looks like. In about 5 minutes, I might tell you to hop into a blue EMA trade. I might even tell you to wait for this line to get touched first. So it all depends. I know it sounds like a lot, everybody, but this is the only way you're going to compete with computers, just so you understand. 90% of most trading activity is done by computers. It's not done by a person because usually these people get lazy, they build some type of algorithm, and then they let the algorithm just trade back and forth for them. So you are competing with a computer. You need to understand that. And you're only going to get the upper hand when you can see the pattern the computer has. Oh yeah, I forgot to post the Tesla trade. All right, let's go back. Let's continue to fix this. Once I have this done, we'll move on to the next piece of text that I need to fix. For now, let's just, get this done. play. All right, everybody. It seems that I'm talking to an empty crowd today, so out of respect for myself, I'm just going to take the time off for the rest of the day. I'm going to get into the trades and post them on the Discord, and we'll just move from there, pretty much. In terms of the SPY trades, the next thing we want to do is, let me think. Yeah, just wait for number 4. Pretty much once you hit number 4 and you're right by this red line, you're going to average down on any puts you bought earlier this week. Make sure you have puts at least for next week, right after FOMC. And then once we get to Monday, we're going to instantly market fill those puts at opening price. We want these puts to go in the money, so just make sure you're not getting something too far out, something too expensive. Just make sure it's like right in the middle, and you should be good. You should be A-okay. Now, in terms of what to do tomorrow on Monday, we're looking for a V shape. Maybe it might be upside down one, so it's going to be something like this here. It'll be something like this, and then boom, right back down like that. The whole entire day.